Hello, good afternoon, and welcome everyone to Network 2020's discussion about central bank digital currency. Is the US losing the race? My name is Courtney and I am the president of Network 2020. Network 2020 is an inclusive international community, and we bridge the gap between the private sector and the foreign affairs community. We really try to highlight and drive innovative solutions to challenges in foreign affairs. We run a number of programs, including this briefing series, but we do others as well, including upcoming research to Tunisia. We're supporting entrepreneurs in Bosnia. So we do all sorts of things. We also have a deep dive program on China for those of you who are in New York, and that's accepting applications now. So please do check us out. So with countries around the world that are grappling with how to address the growth of cryptocurrencies, from outright bans in some places to the adoption of Bitcoin as a national currency in the case of El Salvador, another question has arisen, and that's, do countries issue their own digital currency, and what does that mean? So today we are joined by three experts to talk about global trends in central bank digital currency and what that means for the global economy and geopolitics. So I am so pleased to welcome our panelists. First, we have David Yermack. He is a professor of finance and business transformation at NYU's Stern School of Business. Welcome, David. We also have Julia Friedlander. I apologize. Here we have Julia. She is the C. Boyden Gray Senior Fellow and Director of the Economic Statecraft Initiative at the Geoeconomics Center. And lastly, but not least, we have JP Schnapper-Casteras. He is the founder and managing partner of Schnapper-Casteras PLLC, which is a boutique law firm that advises technology companies, nonprofits, and individuals about cutting edge regulatory issues, litigation, and compliance. So with that, welcome to each of you. It's a real pleasure to have you here today. JP, I'd like to start off with you, and I'd like to start where I usually like to start, which is to get everyone on the same page. So could you walk us through what are some of the different categories of digital currency, because the term gets thrown around a lot. You know, we're talking about central bank digital currency, but there's stablecoin, there's crypto. And what makes a central bank digital currency different from the kinds of digital transactions that we're currently making? And lastly, just to kind of add on to that, why has this conversation really started to heat up now?
Well, thank you for having me and putting together such a fun panel. Excited to dive in. As you said, I mean, there's so much going on in this space, so many acronyms, and we see headlines every other day about this cryptocurrency or that, and you know, some of it good, some of it bad, some of it silly. So I just want to sort of zoom out a little bit and to paint with broad brushstrokes. There are sort of three different types of digital currency, which I think we can categorize for today's conversation. The first is central bank digital currency. That is to say, digital currencies that are or someday would be issued or authorized by the central bank of a nation, by a sovereign government, like the Federal Reserve here in the United States. This is sort of a work in progress. You know, there's many pilot programs and research programs happening all over the world, including here in the US. But a lot of the features about what exactly would this look like, you know, how would it be used, that is still under exploration and debate. And there are sort of two different models of CBDC, which we may get into, two basic scenarios. One is the central bank. The government sort of directly offers and issues the tokens, or offers sort of public accounts, digital accounts or wallets to citizens. And the second approach is that the government works with banks or financial technology companies to provide the tokens sort of indirectly. This is called the disintermediated approach for CBDCs, or sometimes called a two-tier approach, because instead of directly getting in the business of offering tokens or software, they do it through another provider, but still with the imprimatur of the government. The second big category of digital currency is stablecoins, related, but a little different. The aim is, as the name suggests, to be stable, given that there's a lot of volatility in the crypto markets, to put it moderately, some days. And probably the most popular, sometimes also called crypto dollars in the American context, because they're dollar denominated tokens. But these are privately issued and developed, not sort of blessed by the government. This has really exploded in recent years through companies like Circle and Paxos and Tether. There are $130 billion in so-called crypto dollars that have been that are in circulation right now. We could talk about why that is, but they're sort of private dollarized stable coins, if you will. And the third category of digital currency, which is perhaps most often in the news and ripe for debate, is sort of cryptocurrency, private cryptocurrencies, plural. Bitcoin, everybody knows Bitcoin now, and Ethereum is the other big one. Those are sort of the oldest and have the clearest legal categorization from a regulatory perspective. But there are a lot, thousands of other smaller token projects and cryptocurrencies, which, do different things. And we can talk about why that is, but it's sort of fair to call some of those digital currencies. Some of them also, we would just call tokens, right? Tokens for some new project or network or application that may or may not exist today. Why are we talking about this now? I think the two main reasons are digital currencies can do some cool and very functional, useful things people have come to discover. They can be essentially instant, 24/7. You don't have to wait for your local Wells Fargo branch to open and go and fill out the paperwork and pay $30 for a wire. Depending on the design, it can be potentially peer-to-peer or permissionless. There are different privacy features that can come into play. We can talk about what that means. I won't necessarily use the word anonymous off the bat, but there are different privacy arrangements, some of which look more or less like the features of physical paper cash today. And as a result, as a policy matter, there's some creative things you can do, right? You could send currency in very small amounts. You could set up recurring, for example, stimulus payments to people in the central bank digital currency context. You could have sort of instantaneous, what's known as like helicopter money. Hey, we want to stimulate the economy in this particular way, in this particular time. We don't have to wait 6 weeks to cut checks and go through the IRS and this. It could be in someone's bank account tomorrow. And there's some other potentially implications about interest rates, which I'll let my colleagues get into a bit more. So central banks, I think it's fair to say, are interested in this subject in reaction to what has happened in the private markets, which is just an explosive growth in cryptocurrencies. Bitcoin leads the way, but it's now sort of a $1.5 trillion market cap for all cryptocurrencies and stablecoins all in. Just can't deny that it's a thing anymore. And I think one just quick anecdote is, some central bank officials, I think, went from highly skeptical about Bitcoin. There was a famous incident in 2018 where a senior official from the Bank of International Settlements said it was a cross between, quote, evil spawn and a, quote, Ponzi scheme. And that same official by late 2019 was giving a very different sort of speech about Bitcoin and digital currency, about learning from Bitcoin, sounding almost a touch defensive about how central banks provide public goods and, quote, need to move with the time. So I think that's part of the background factor that's happening here. Central banks realizing other digital currencies have taken off. Bitcoin, Facebook was the elephant in the room for a long time, and thinking, we need to be on top of this. We should be looking into this too. And that's exactly what's happened.
All right. Thank you so much, JP. David, turning to you. JP touched on some of this, but I'd like for you to dig into it a little bit more. What are some of the biggest motivations for governments to adopt CBDC, and what is the potential impact on other players, from commercial banks to social media companies, and really what's at stake?
I think you can summarize this in one word, which is fear. The motivation, and we can see what happened in China with Alipay and WeChat Pay. The motivation is that the central bank could be overtaken by private issuers who most likely would be the big tech companies. Facebook was a bit of a stalking horse, and I think went about it with some fundamental mistakes that aren't likely to be created to be repeated. But I don't see any reason we shouldn't expect Amazon and Google and Apple and other companies like this to begin issuing stable coins that would be very attractive to customers. It's clear that the preferences of the public, especially with younger generations, is no longer to use physical cash. Most economists have concluded that cash will be gone from the world probably within 10 to 20 years, if not sooner. And the question is, who's going to issue the digital money? Will it be governments who will continue to collect the seigniorage revenue as they've been doing for hundreds of years? Or will that seigniorage revenue pass into the hands of Jeff Bezos and Mark Zuckerberg and Larry and Sergey at Google and so forth? The Chinese have already looked into the abyss and seen that Jack Ma had more or less taken over the issuance of currency in China through the Alipay platform. And now they've brought to market, it has a very unwieldy name, but it's called the DCEP, the Digital Currency and Electronic Payment. So China, actually, I wouldn't even call this a test project anymore. They have a live digital currency of their own. And I think that the whole world is going to be repeating the script that is already unfolding in China, that the central banks will be pushed by the public to do this with the threat of the media companies usurping their franchise to issue money, which would be almost a catastrophe for public finance if it were permitted to happen. And I think the big question, JP really touched on this, is what role that commercial banks may play in the system going forward. Up until now, most money is actually created by banks. When they make a car loan or a mortgage loan, they give you a credit to your account. And this is really, something that the central bank delegates to commercial banks. It's the right to create most of the money in the economy. But it's become clear, especially with the advent of cryptocurrency, that banks, first of all, don't do a very good job of this, but they're really not needed in terms of the technology. We could all be banking directly at the central bank, and we could all just have accounts at the Federal Reserve instead of at Wells Fargo and Bank of America and so forth. So will commercial banks play any role in this system in the future is really an open question. It's really a design choice. And if they no longer are payment processors, which is where they raise their money, who would create credit? Would we have shadow banks, things like Quicken Loans, step up and fill the void of lending that would be created if we unfunded the commercial banks by no longer involving them in consumer payments? So these are very big questions. There's an awful lot at stake, but it's pretty obvious that the financial system 10 years from now is likely to look totally different. And I think the commercial banks know that they're facing an existential crisis, and this is a very interesting time for them.
Just to follow up on that, what sort of, is there a tipping point that you would envisage, or something that you're looking at in particular to see whether this is going in the direction of, are we all going to be banking directly with our central bank, or are we all going to be banking with, Facebook or, something like that?
It's a political choice. And I think governments, especially the US government, have been very overconfident about their ability to rein in the entrepreneurs who are creating new payment systems. And the growth of the so-called shadow banks has been so impressive. And in areas like international remittances, where banks have been charging monopoly profits and providing bad services, you're seeing the entry of new companies that are really hiving off a lot of the profitable lines of businesses of the banks. And I'm not sure there's a tipping point so much as gradual erosion, where banks are going to see their margins shrink, their profitable lines of businesses disappear, and they'll probably end up in a bunch of defensive mergers, kind of like you saw in the auto industry. And I think that there's going to be far fewer banks, and they'll be asked to do fewer things. And the real question is whether there will even be banks at all. I think Bill Gates very famously said there will always be banking, but there won't necessarily be banks. And I think some banks have come to terms with this already. JP Morgan, probably the most aggressive in the US at trying to remake its business model. Others are, in abject denial or even ignorance about the threats that they're facing. And it's going to be interesting to see exactly what happens to them. But I think being a first mover in this space is going to be critically important, because it's a very hotly contested area, and there's not going to be room for everybody who's now in the market to stay in the market.
Thank you. Julio, turning to you, you helped create the Geoeconomics Center's CBDC tracker, which is looking at who's adopting digital currency around the world. So based on your 30,000 foot view, which countries are leading the CBDC race, and where does the US stand in this process?
Sure, thanks, Courtney, and then I'll share in the chat the CBDC tracker in a couple of minutes. This is also something that, and JP has actually been a part of this project as well. I take no personal credit for its construction, but what we're able to do is through research and extensive conversations with central bankers and governments, is understand where every country in the world stands on CBDCs. And what I can say is that right now, we just added Russia yesterday as being in the pilot stage, is that there are 91 countries globally who are in some stage of research and development of a CBDC. And that's up by 60 over the past year and a half. Okay, so this field is exploding. And I think some of my colleagues here, both JP and David, have touched on sort of reasons for doing this are wide and varied. Okay, so say you have the Bahamas, right? Which is, I think is maybe the most farthest along actually is in using the sand dollar. Now we talked to the central banker there. Why are they doing this? They have a small country with thousands of islands. The Caribbean is always at risk of being de-risked by commercial banks from correspondent banking relationships. And I can go into that a little further if anyone's interested. And so they need to find a way to and it's still a relatively poor country, right? So you need to find a way to distribute money through a sort of unique geographic jurisdiction when your connection to the global financial system has been historically tenuous. Then you have a country like Sweden, right? Also very far along, and the Riksbank there is sort of the leader. The Swedes, obviously they have the Corona. They're not part of the Eurozone. Are the furthest along in Europe in developing this concept. And there, I think that Scandinavia has always been at the forefront of financial technology. They've been trying to get rid of cash for years because they find it inefficient. And I also have probably long-term considerations over the role of an internationally traded currency that is pegged to the euro, but isn't the euro, right? So to defend the value of a sovereign currency. Then you have, of course, you have China, right? And I'm sure we'll go into this a lot further. And JP and I have worked on this a little bit, and I'm sure he'll want to jump in on this as well. The reasons that we believe the Chinese are interested in the digital yuan are varied. One is financial inclusion, right? Getting to the regions. One is keeping control over the financial system in the Jack Ma scenario, right? We're essentially making stable coins out of the Chinese economy. And what does that say for monetary policy? The third, though, and I think this is where the monetary policy crosses over with national security most clearly, is in surveillance, right? And JP touched on privacy choices. There's clear evidence that the Chinese would like to use the digital yuan to know who is going where and who is paying money for spending money on what, right? It's the new sort of it's the new intelligence service in a way, right? And I think that's a cause for concern for us. When it comes to the United States, okay. A lot has been written, and this is something that we agree with at the Atlantic Council, is that the United States is really far behind on this. One, as we've just said, we've had a lot of faith in the dollar-denominated system and the U.S.-designed Bretton Woods system that it is infallible. Of course, it's not infallible, but in my experience, and I was at the Treasury Department until a year and a half ago, was that there were 3 people working on digital currencies at the US Treasury Department. Now, of course, digital currencies don't only reside in Treasury. It's the Federal Reserve, it's the SEC. There are a lot of people in this pot. But the US Treasury Department has a pretty big role in deciding the policy direction on this in conjunction with the regulators, right? 3 people. Right. And so I think that reflects sort of the imbalance between the private sector outside world perception of what lives in the digital currency space and what the government still believes sitting in Washington. Right. Maybe, the Federal Reserve in New York has a better idea because they're talking to the banks the whole time, right? So that sort of geographic myopia should not be overlooked. When I had the opportunity to deliver a testimony at House Financial Services over the summer on central bank digital currencies, looking mostly at the national security side, but there were, we was a panel, and I was asked by Alexandria Ocasio-Cortez about financial inclusion, right? There was a big, in the wake of the COVID crisis and the inefficiencies in getting financial assistance and the stimulus payments out to individuals, getting wrapped up in the IRS, getting lost in the mail, commercial banks having to lower their risk thresholds by essentially by treasury fiat, so that they would actually bank people they normally wouldn't bank to get money anywhere. So CBDCs are a potential way out of this, without transaction fees, without overdraw fees. So it is a potential opening for opening on the financial inclusion side. But again, we're far behind, and we can go into that.
Thank you so much, Julia. JP, you specialize in a lot of regulation. And so looking at currencies, which have changed their forms over the centuries, and regulation is usually evolving to adapt to that change. But from your perspective in law, working with a range of new technology issues, and this is maybe a bit tongue-in-cheek, but is technology outpacing the rate at which we can make these changes today? And how are governments dealing with this change, and how would you like them to do so? So how quickly is the technology evolving, and how is regulation able to keep pace before it just changes again?
Well, I'm going to give you an equally lawyerly answer, which is yes and no. No, insofar as laws don't always have to keep pace with the latest technological iteration or development. Right? Congress passes laws with a very broad purpose that apply to a range of scenarios. It's usually considered quite beneficial for technologies to be, for laws to be what's known as technology neutral. Right? We don't pass. We didn't pass the AOL Modem Act of 1989. We passed the Telecommunications Act of 1996 to apply to a broad range of scenarios, and because those laws tend to, that's just sort of how, now whether that's good or bad, maybe it would be better for Congress to pass more laws and revise more laws, but that's generally the nature of our system. And the SEC, the federal agency charged with securities and exchanges, has had no trouble or really reluctance for applying the Securities Act of 1933 and 1934. These are laws now, almost 90 years old, to the concept of digital currency. So in that sense, no, there's no difficulty in keeping up. But in another sense, yes, I think, obviously this area has exploded. And one thing that's noticeable is if you look on the Code of Federal Regulations, that is to say the public published register of federal regulations, there is not a single, I checked this week, there is not a single mention of cryptocurrency, virtual currency, or digital currency anywhere in the Code of Federal Regulations, which is pretty striking, actually, if you think about it, because that's not even a law that Congress has to pass. That's say an agency saying we have some authority under an existing federal law. We're going to issue a regulation that spells out, okay, you can't sell securities. Here's what we think that means in the crypto context. I think it's fair to say there is a gap between, there's an enforcement gap that goes on in crypto between the rhetoric that some senior policymakers put forward about, whether they like crypto or not, or how it should be treated legally, and the reality is a matter of enforcement and compliance. The sector has obviously exploded in a sense that the horse is out of the barn. And as a lawyer, there's lots of, it's actually sort of hard to give legal advice in this area because there's a tangle of different old laws and speeches and guidance and, frequently asked questions posed by agencies, which you sort of have to put together to suss out what the position of any given government federal agency might be. So I think it's a work in progress. Exactly how and when the federal government might sort of catch up. There are, just as of 2021, Congress was considering 35 separate pieces of legislation that are in some way related to central bank digital currency or digital currency across, tax reporting, securities law, CBDCs, ransomware. I mean, there are like 7 or 8 different categories of bills currently under consideration. So, I think there will be some meaningful legislative action on this front in the next couple of years. But it is a complicated landscape, and I won't say it's totally caught up with what's happening on the ground.
Great, thank you, David. One of the potential hazards of central bank digital currencies, and this was mentioned very briefly earlier, is the potential for negative interest rates. Could you please describe why this is, and then how you see those effects manifesting in the global economy?
Yeah, if I might, I'd actually like to address 2 potential hazards. One is the US has a huge export franchise in suitcases of $100 bills. The physical cash that circulates outside the United States exceeds what actually circulates inside. And this is used plain and simple for money laundering by bad people. And if we go to a digital currency, we would lose the export of hard currency, which is one of the only export industries we have left. And we would have a very difficult question about what to do with the inbound suitcases. Do we put El Chapo onto the national blockchain, or the Friends of Putin, or all these other folks who are carrying these suitcases around? And I think the slow movement of the US in this area is because this problem is so obvious. And it's, I think the US, for this reason, will be the very last major country to go down this road, but inevitably will have to. And if there are 3 people working on it at Treasury, Julia, that's 3 more than I was aware of, and that's maybe good news. Now, the issue, though, with negative interest rates, I think, is the 800-pound, gorilla, the elephant in the room. There have been long-term demographic changes that have pushed interest rates to 0 or even below 0 in most of the major market economies. And just to summarize very quickly, it's really the fact that major countries like China and India that used to be poor are now middle class. And they save very differently. They don't have lots and lots of children. Instead, they save for retirement the way that Western market economies have for a long time. So there's a much greater supply of savings and lower interest rates. This is not going to change anytime soon. And in fact, negative interest rates will probably be the norm in most of the world for the foreseeable future, for the rest of our lifetimes. You can't pay negative interest rates with physical cash, because that yields 0 and people put it under the mattress. With electronic money, the central bank can erase 2% of it or 3% of it every year. This would be deeply unpopular, but it's also unavoidable. I think negative interest rates are not only here to stay, they're going to get more negative. And governments, just because of supply and demand in the capital markets, will have no choice but to find a way to pay negative interest rates. And this really implies that all money will have to be electronic. So there are many very interesting other issues about surveillance and the convenience of payments and so forth. But I think the negative interest rate question trumps all of them, that even if none of those problems existed, we would be doing this anyway because of the need for central banks to let interest rates go negative in a way that people wouldn't fight back against with hoarding physical cash.
All right, something interesting to keep an eye out for. And then taking off on your first point about the money laundering, Julia, turning to you, on the flip side of that, CBDC is being hailed as a regulated alternative to cryptocurrencies that could counter the risk of illicit financial flows. So with your background, what can you tell us about this? How does CBDC create an opportunity to combat risks associated with cryptocurrency?
Sure. So it cuts both ways for different reasons. First, I think, as David said, right, about suitcases of money, of dollars going in the world, it's not only for El Chapo, it's for the global economy, right? To hold physical dollars. There are countries who use dollars as their, official or pegged currency, right? Ecuador, Panama, Cambodia, right? And so I think one of the blessings of a dollar-based global financial system, of course, is that we get to say a lot, right? And we get to set the framework. And I think that that's part of the reason why the U.S. is being so cautious, is because we have a global responsibility, not only for a small country like Sweden, but for a global denominated financial system. And so the caution in the U.S. I think is warranted. But I think as you say, we are going in that direction. The world is going in that direction. The U.S., I don't think will be the last. I think that might be sort of somewhere in between. But what we're really trying to advocate for right now, and then we get asked by this at the G7 and the G20, please give us a model for something, right? Play a role in this space, even if we don't do it ourselves actively, because otherwise someone else will, and they'll set the model that in the U.S. will be a follower, right? And when it comes directly to money laundering, right, there are a lot of traditional thinking, would say, the current anti-money laundering system that we have built out in the post 9/11 era, pursuant to the Patriot Act, requires on commercial banks participation in other obliged entities, right? And there's a big question over making people more entities obliged to file suspicious activity reports, right? To actively tell us what they see transacting through traditional channels, right? Reporting those to the U.S. government, even reporting them to each other through another mechanism to try to counter terrorism finance and money laundering, right? In the case of a central bank digital currency, you're not going to have SARS in the same way, right? So the whole framework that we have to detect illicit financial flows, whether it's through commercial transactions or through SWIFT, right? That will have to adapt. Okay, so there will be sort of a gap, right? But because central bank digital currencies, because transactions are inherently, everything can be traceable, right? And this gets to privacy concerns. Everything is traceable. So that means that potentially we have a much greater access to any money moving where around the world instantaneously. And you can aggregate that, especially if you have data sharing agreements between governments. But of course, that comes with a lot of risks too, because you are essentially, what one person's privacy concern is another person's national security and law enforcement concern, right? And we have this with data sharing agreements already that sort of are falling apart between the US and the EU, right? So there are, again, it's a great opportunity to be able to follow initial financial flows, but there are so many different issues that have to be hammered out beforehand before that is feasible for a government like the United States or for the Bank of England or for the European Union.
Great, thank you. I will start turning to the Q&A box. So if you're in the audience and you have a question, please feel free to type it into the Q&A box. And we have a couple of questions, and I'm going to direct this one to you, JP, but Julia, David, feel free to jump in on it. We're having a couple of questions around the environmental impacts of crypto. And so what do you see happening on that front, given the extensive electricity used to generate some digital currencies? How could the adoption of CBDC affect those ESG concerns?
So, great question. This comes up often in the Bitcoin context because Bitcoin uses a model of is designed around something called proof of work. So in order to get Bitcoin originally for this sort of the decentralized series of nodes, then they get Bitcoin in return for performing sort of solving complex mathematical problems. And by doing that work and proving that you've done that work, you get a little bit of Bitcoin. So people now compete and have specialized computers to try to get Bitcoin. And it's a way, it sort of provides an economic incentive both to obtain Bitcoin on the front end, although there's a fixed supply of 21 million Bitcoin overall, but also for different players and different nodes to keep each other in check about what's happening on the Bitcoin network, essentially, and to validate each other's work. That's why it's called proof of work. And as Bitcoin has gotten more and more expensive, people have put a lot more money and computers and electricity behind doing that. This is there are obviously some real issues there about the amount of electricity used and how is that being generated. Where is it being generated? It tends to migrate to the cheapest. Interestingly, it tends to migrate to the cheapest electricity on the market. And there was a number of interesting studies written about locating Bitcoin mining facilities next to hydroelectric dams or natural gas plants where there's flaring because they can use excess capacity to all of a sudden switch on a Bitcoin mining machine. There are different central bank digital currencies would probably not, my guess is would probably not use a model that's like that. They would have a sort of semi-centralized or a system that's partly distributed to banks, more akin to a traditional, having very powerful computer servers. Now, that large computer networks use a lot of energy too. The amount of energy that we all use every day on Spotify and Netflix and Gmail, and the privilege of having these always, being able to access any piece of media in the world at any moment from any device, that also uses quite a lot of electricity. Data centers in many states are the leading consumer of electricity. So I don't want to totally sort of write that off. The one caveat I will say is, a lot of the math around Bitcoin energy usage seems to be fairly speculative at this point. And so if you see a headline that says Bitcoin will result in 6 inches of a sea level rising in the next year, there's been a lot of counter critique that scholarship in math is not terribly precise. Let me just say that.
Great, thank you. I'm going to direct this one to you, David, and again, feel free to jump in. And so the questioner wants to know, what is the effect of cryptocurrency on the poorest people in the world, and can cryptocurrency address income inequality?
It's an interesting question because we have a couple of billion unbanked people in the world who just don't have access to routine financial services, either because banks can't reach them because of the physical distances, or in the United States, because banks won't let them be customers because they don't have the income or the credit scores. Anybody can use cryptocurrency. You just need a connection to the internet. And the number of unphoned people is much less than the number of unbanked people. There are many people who don't have bank accounts, but have mobile phones or smartphones and could easily hook into this market. So there has been almost a utopian belief that decentralized cryptocurrency could solve problems of financial inclusion. And I think if we had central bank digital currency where every citizen had a wallet at the Federal Reserve, it would be much the same logic, that you wouldn't need to pre-qualify or make any kind of financial case for why you should have the privilege of a bank account. It would be, in fact, a matter of right. Now, having said that, the progress in this direction has been pretty incomplete. You've seen very little adoption of Bitcoin and decentralized cryptos in the Southern Hemisphere. They tend to be used most intensively in rich countries that already have pretty good payment systems. And they're also really used more as speculative investments than as payment systems in the first place. So I think the promise and the potential here is, at this point, mostly theoretical. But I do think that aggressive government programs could do a lot to draw people into the financial system using digital currency. And I would point to the Aadhaar identity program in India, where they've used biometric IDs. They've gone out and fingerprinted 1.1 billion people. And they've, in parallel with that, passed a law that you can get a bank account as a matter of right in India, with your authentication coming from the digital identity that you get from the government. So I think there are great potential in areas like this to use digital assets as a way of onboarding people to the financial system, allowing them to make just very basic savings, investing, and payment transactions for the first time. And there's a potential to lift out of poverty a very large number of people around the world just by bringing basic finance to them.
Thank you, David. Julia, turning to you with a question about security. Someone wants to know, how is one to know that a cyber attack wouldn't remove all the funds of a private or public account? How I mean, that it seems like there's a huge risk there. And so how are you looking at that, and who are the different players, and how are they handling that differently?
That's a really, really good question. And the Atlantic Council is about to put out a report on digital currency, co-sponsored with our Geotech Center, specifically looking at this question. I'm not a real expert on this space. What I can tell you is that it is a significant risk. Either through hacking or through taking down of physical systems, right? The incident of the colonial pipeline of Russian hackers who are now sanctioned because of their activities. There are a lot of different openings. If you, I would say is it's not necessarily more dangerous than current financial systems. It's just different, right? And this is, again, adjusting your money laundering framework, anti-money laundering framework. You have to adjust your cybersecurity framework as well. And this is a new space. So I think that there is, if you are a criminal, you are going to try to exploit the different opportunities that it might present, and especially in an unregulated space. So right now there is significant risk of that. There are incidents of crypto wallets being seized and hacked, and I think that is a Bitcoin risk as well. So I perceive that as the regulatory framework is built out, especially around crypto, right, which we anticipate, in reading the tea leaves with the SEC, probably going to come in short order, that there is going to be a framework put in place for cryptocurrencies that might actually lead to a great consolidating of the sector. There will be a significant cyber component to that as well.
Okay, great. We have a question, JP, I'll turn this one to you. What are your thoughts on proof of stake consensus mechanisms for crypto as a way to reduce the environmental impact?
So this is a different way of, instead of proving that you've done a certain amount of work to validate a transaction or get a cryptocurrency, just showing that you already have a certain fixed stake in the network. There are a lot of new token projects that are trying this. Some use different environmental. Some sort of prove their stake with hard drive space. Some prove their stake with encryption keys or certificates. There are different ways of doing it. I think a lot of it's tied up with the sort of functionality and economics of the token in general. So maybe it's better. Maybe it's better in terms of energy usage, but maybe it has other downsides in terms of being speculative or something like that. So I think the jury's out. On there are a lot of positive features of having an open source decentralized network like Bitcoin as well. And I think the jury's out about if these other models will overtake the reign of Bitcoin.
Okay, great, thanks. David, let's turn to you for this question, which is, what basic infrastructure needs to be in place to implement CBDC? And I use infrastructure as a very loose term, whether it's digital, whether it's what we've touched on before with the environment and the energy needs. What is it that, or is it some sort of regulation? What is it that you're looking at that would need to be in place?
In fact,
this to be implemented?
I have a lecture that we use in the classroom at NYU. What do we need to worry about? And the first thing is the cybersecurity, which was the question you just gave to Julia. But the infrastructure issues are interesting. I think in the United States, we're just fine, that we've got a pretty well-developed grid. There are areas of the country where the broadband service is not great, but the infrastructure bill is probably going to be addressing this. There are countries in the developing world, and El Salvador comes to mind, where they declared Bitcoin legal tender, but didn't have anywhere near the sufficiency of the connection points and the resiliency of the electrical grid and so forth that you would really need to run this. So you need a well-developed electrical grid, and you need people who are able to connect. And what you really worry about is that there's a segment of society who just don't like to use computers. The US, we still have a lot of people writing paper checks, which is something of an embarrassment, but they're out there, and they have, they're like 8 or 10% of the population. And this tends to be a generational thing. I think with my kids, they may never even learn to write a paper check, but my parents still pay all their monthly bills by writing checks. And there will be people that if you flip over to a digital system, will be very uncomfortable using a smartphone, will have no experience, and there's going to need to be a transition period and a fairly gentle onboarding. And whether this is going to be something that takes 6 months or 6 years is, I think, an open question. The country, though, that I think is interesting is Sweden. Sweden is an older country that was very much a cash-based economy until recently they introduced something called the Swish network, which is an interbank payment system that has led to the almost complete abandonment of physical currency. And even though these are folks with an older age profile, you see them with smartphones sending money back and forth and paying restaurant bills. In other words, the onboarding happened very, very quickly and was even something that people seem to have enjoyed in Sweden. So I think we can learn from countries that have gone through this, but you need to get pretty uniform adoption of the mobile phone as a point of contact. And we're about 90% of the way there, but that does leave 10 to 20 million people we need to worry about onboarding in the US. And I think other countries have this problem to greater or lesser scale. But infrastructure, with the electrical grid and the smartphone network is essentially what we're talking about.
Thanks, that's a great answer.
Julia, Julia has her hand up.
Julia, yes, go, please.
The two finger. This is think tank language, okay? No, I mean, I would say one thing that, just to build on what David was saying was that, this is a scalable object, right? And there are perceived uses for crypto, for stablecoins, and for CBDCs in different sectors of the economy and for different purposes, which accounts for, age or age preferences or sector preferences. I just paid a contractor at my house. He's 25. He asked for a paper check too, right? There are all kinds of all sorts of inefficiencies within the U.S. financial system. Built over time, decentralized, fractured. How many regulators do we have? There are a lot of questions that will have to be answered. And I think whatever model we choose is going to be in a phased and sort of, there'll be a period of a very complicated overlapping payment systems.
Great, thank you. And we're actually getting a question about that, about whether there's this sort of long-term model of coexistence, which it sounds like for logistical reasons, it really does need to be that way. David, I'm going to give this question to you. So the audience member wants to know how much of the interest in CBDCs or use of blockchain for payments is due to the lack of real-time payment settlement? And how does the coming introduction of FedNow impact this space? And so if you could also explain what FedNow is, and maybe that's a question for you, Julia, too, actually. So
yeah, I'm going to pass on the FedNow, but I would talk about on the stock exchanges, which is probably the most relevant comparator. It takes 2 days to settle an equity trade. If you buy Apple Computer, there's a clearinghouse that goes through about 7 rounds of offsets and error checking and redundancies. And they're now talking about reducing this to 1 day. In fact, the SEC is now, recommending this. It's embarrassing. There's no reason that this shouldn't happen instantaneously. And the reason it takes so long is that the system is so decentralized, and it really never got out of the world of paper stock certificates that, in the 1960s, Wall Street had a paperwork crisis, and most of the stock certificates were turned into computer memory, and you no longer had to cart them around in wheelbarrows. But the software and the protocols never caught up. And in many ways, we have a 19th century financial system where rules were laid down in the very early years of the market economy, and they were never updated, really because we have such a decentralized system that really for political reasons has not concentrated authority and not had many incentives for innovation. But I think many people have grown frustrated, and the speed of international bank transfers, it can take 5 days to send money from New York to London. And it doesn't need to be that way. And I think the competition from some of the shadow banks have essentially been catalysts for things like the SWIFT network finally to think about modernizing themselves. But really, this should have happened 20 or 30 years ago.
Great, thanks. JP, I wanted to turn to you because we've hit upon the idea of privacy a couple of times. And so I'd love to just hear your thoughts on, what is that intersection between cash and privacy, and how does that evolve with CBDC?
Sure. So first, I guess I would push back respectfully on David's comment earlier about El Chapo and cash, and the sort of idea that he's certainly right that they're about the circulation of $100 bills outside the United States, that being a huge factor behind, in terms of policy making. I guess I would push back on the idea that all the sort of intimation that paper cash is mainly used at home or abroad for money laundering, and that there's anything inherently nefarious about about cash or some of the privacy protected features of paper cash. First, just fun fact, when El Chapo had large amounts of drug proceeds that he needed to launder, he didn't need to cart around $100 bills. He just went to HSBC, and they in fact paid a record fine because they were, they laundered about $880 million of his money. They paid a $1.9 billion fine. So it's sort of complicated how some of this, the relationship between cash and the banking system. I think cash is in a sense neutral. It's used for good things. It's used for bad things. It's used for things that you may think are good that I think are bad, or things that I may think are bad that you may think are good, right? Sort of gray area markets as well. So I just want to put that out there. And privacy, I think privacy is a huge question. It's certainly a constitutional value in the United States in terms of the right to privacy. The precise contours of that in the financial context are hotly under debate. Just to make it a little more pointed, if I might, because sometimes we say, okay, what does financial privacy mean? I guess to put it more affirmatively, would you be okay if every single transaction you ever engaged in, everything you bought, when, where, and maybe with who, was affirmatively sent and centralized in a government database? That is what one model of what this might look like. Now, some people would say, yeah, I'm fine. I have nothing to hide. Some people might say, actually, no, I'm not sure. I'm not sure I'm comfortable with that, for various reasons. Or hey, if I've done something wrong, or the government suspects I've done something wrong, and they have a warrant, you're welcome to come to my bank account. You're welcome to, welcome or not, you come to my house, you have a warrant, you can seize things in my house, right? And so I guess I just wanted to pose that a little bit more concretely, because that is, when we're talking about financial surveillance and privacy, really it's like, if every Visa transaction you ever owned were permanently stored in a federal database, how would you feel about that?
Yeah, I think, this is a very interesting question. We talk about this in class. I would say that in today's world, with all the identity theft and hacking and, the cookies on your browser, shouldn't be any illusion that the situation you described is pretty much already what's happened. But the people who created Bitcoin were actually motivated by privacy, and they got it completely wrong. They thought that they would enable people to evade detection by having these pseudonymous wallets, and they greatly underestimated how easy it would be to trace them. And the Chinese, very interestingly, when they rolled out their DCEP project, they used the phrase controllable anonymity for how much privacy there would be, which I took it to mean that we will control how much, in other words, there will be no privacy. But I think in that culture, it's also the case that it's not as important a political value as it is in the United States. There are no questions that libertarians view cash as a defense against government surveillance, that cash is a method of protecting personal privacy. And I do think that digital currency may be resisted for that reason, but the irony is that it's the libertarians who created Bitcoin and who are using it right now to fund the Canadian trucker blockade and so forth. But they're also leaving their names and addresses for the government to go visit them later. And I think in the computer age, that ship has sailed. You know, as much as I would like not to be followed and watched, it's already the case that the government can do this. And anyone who doesn't realize this, I think, is hopelessly naive. And, you know, it shouldn't make anyone happy, but it is the state of affairs. And I don't think turning back the clock is a realistic option.
Yeah, I mean, I'm certainly not, I hope I'm not coming across as naive about the realities of the digital trail that we all leave when we browse the net and you walk through a city with with a lot of
your smartphone is being downloaded step by step, where you go, how long you browse each storefront window, all that stuff.
That's true, and it's a lot. If you use Google Maps, it's certainly collecting a large amount of data. You can also choose not to use Google Maps, and if the government needs certain data from Google, they need a warrant. So I don't think you can both lament the state of privacy in the United States and want to advocate for it to go in a slightly different direction.
It's just so universal that if I were looking, for the local axe murderer, I would say, well, who turned off Google Maps? Who are the 0.5%? That's the list I'll start with. And
well, if you can convince the federal judge to give you the Google data for everyone who turned off their phone, let me know. But I think that's tough. That's a tough one.
I mean, I think that beyond privacy, there is the aspect of, putting money under your mattress, right? That or holding gold bars. And I think that in times of financial crisis, there are, that concern exists. And I think that when you talk about negative interest rates, right, there are concerns that, the government could just decide without, just overnight to sort of absorb my money, right? And that's, without the sort of course, that happens over time if you, over time anyway with inflation, but there are greater risks of that there. One thing I sometimes say is about this sort of anonymity thing is that the current financial system, and this is getting to the El Chapo issue, is that if I were a money launderer, right, I would not use digital currency because it is, there are so many good ways to evade capture or detection through the current myriad shadow companies and offshore jurisdictions and everything that my team at the Treasury Department tried to break down, but most often could not, because it's like a needle in a haystack, right? If you want to evade sanctions and you want to El Chapo wants his money to end up at HSBC, maybe HSBC doesn't even know that it's El Chapo's money, right? And so I think this, there is a certain aspect of the complete inefficiencies and corruption issues that have been associated with the global financial system as it currently is, that I think will over time get absorbed into this debate as well.
Yeah, we have a young couple in New York who were brought in last week with $4.5 billion of Bitcoin. This is Razzle Khan and her alter ego husband. And, they were maybe the most extreme example of why you should never use crypto to launder money. We make this point endlessly to our students, and I think they've already figured that out.
Yeah, we had a conversation a couple months back about offshore banking, and this conversation came up about technology and how that's affecting people who are trying to put money in offshore banks or hide it in some way, shape, or form, and that there's actually a new a lot of people are now using free ports, near airports, to store
Geneva.
Art and other, it's almost like sending it back into some more antiquated form of holding value. So I thought that was a very interesting aspect, but certainly a lot more to be discussed. Thank you all for helping our audience understand what's going on, because it clearly is complicated and it does seem sort of like a wild west out there. My biggest regret is that when I was posted in Turkmenistan about a decade ago and wanted to buy some Bitcoin, my internet connection was so poor that I wasn't able to, but maybe it's for the best. So on that note, thank you all for joining us. You clearly are, know so much about this topic, and it was a real pleasure to hear from you. And thank you to the audience for joining us. Thank you to Brian and Casey for helping us out on this event. Our next event it's a private member only discussion with Angela Stent on the Ukraine-Russia conflict. That will be Wednesday, February 23rd from 6 to 7:15 Eastern time. It's for members only. If you would like to become a member, please do feel free. You can scan and the QR code, and Brian will help you get all set up with that. And with that, I just want to say thank you all. Oh, we're also doing applications for our deep dive in China program too. So please do feel free to apply to that. David, Julia, JP, thank you so much. It's been a real pleasure, and have a wonderful afternoon.
Bye, everyone.
Thank
Thanks
you.
for the invitation.
Bye-bye.
Bye-bye.